Suyash Choudhary, Head of Fixed Income at IDFC, joins us right now on the show. Suyash, I will come to bonds, I will come to what yields are doing, but can't help but open this discussion with what's happening on the currency the last 3 or 4 days. Very volatile, on a downtick for most days apart from today. What's the call, what's the view in the near term?
Well, in the near term, there are sufficient tailwinds that have gotten generated for the rupee. So if you contrast this to, let's say, 2.5 months back, when global markets were very worried about an imminent Fed taper, and we were fretting more specifically with regard to the local current account deficit, a lot has changed since then. With respect to the Fed taper, now the latest debate is whether, in fact, they will start to taper in Q1 of 2014. So we have a near-term reprieve from that event. If you look at the current account deficit assessment from $88 billion last year, most estimates are now hovering between $55 and $60 billion this year. If you add the fact that we have already gotten around $10 billion on the FCNR plus banking capital initiative, so the external account for us is looking much better now with respect to what was there before. So that is clearly a tailwind that is cropped up for the rupee.
So are you saying that if indeed the tapering doesn't happen until January or even gets postponed even then there is a significant likelihood of the currency, that is INR, appreciating meaningfully from these levels?
Well, I wouldn't know about meaningfully yet, but there is decidedly a chance that we break the 60 band over the next 2 to 3 months. If you look at, many global asset managers over the last week have reinitiated long emerging market trades. So if you look at what's happening in Indonesia, bonds, they have rallied smartly since the US reached a debt ceiling agreement. Similarly, I am hearing a lot of long Asian currency calls emanating from various houses. So if that picks up pace and hypothetically the JP Morgan index inclusion for Indian bonds happens, then I don't see why we can't break 60 as well. I mean, the near-term concern for rupee, if anything, is only this, that oil marketing demand is still out of the interbank market.
Okay. The other call is that you mentioned right now that tapering could well happen in January. Now, a lot of people believe that Janet Yellen is a lot more dovish than what Ben Bernanke has been. And there is, the hopefuls or the optimists are saying that there is a strong likelihood that tapering may not happen even then. It could well be mid or late next year. How high do you rate the chances of that?
I would rate them as significant in the sense that if you look at what happened with the taper debate over the last couple of months, I think the essence of the problem is that the Fed is unable to successfully disassociate taper from market expectation of future rate hikes. So let me explain that more specifically. Whenever the Fed starts to move towards taper, markets automatically start to price in an earlier rate hike. And that is really what leads to tightening of financial conditions, increase in interest rates, increase in mortgage rates. So I would think, the path to exit is not as clear-cut as generally gets discussed right now. So I would have an open mind there. We would think that Q1 of 2014 as a start to the taper is a distinct possibility. But I wouldn't rule out an even later taper. I would certainly not rule out a fact that even if taper starts, the total unwind may be actually a multi-year process.
Suyash, afternoon. Of course, now all eyes will be on the next big driving factor apart from the global events that we've been flagging off with respect to the RBI policy. And do you think that, the RBI governor is going to tinker once again with the MSF rates in addition to a given perhaps of a repo rate cut of 25 bips?
Yes, as a base case, we would expect a 25 basis point repo rate hike accompanied with a 25 basis point MSF rate cut. At this juncture, bond markets and more particularly financial markets are worried about the future reaction function of this new RBI, especially in context of the fact that the last set of inflation prints have surprised on the upside. But our take would be, if you look at all the words and actions of the new RBI governor since joining office, Clearly, he wants to anchor policy around inflation, but that doesn't necessarily mean that he's an inflation targeter. So, he wants to anchor markets' perception of policy around inflation, but I think he will keep the weak growth environment in context when he attacks inflation. So, which is why, we would look for 25 basis now, possibly to be followed with a prolonged pause.
But inflation does, in fact, remain one of the chronic problems that the RBI does need to address. Speaking of which, given that we saw that startling food inflation number last time around, what's the expectation as to where inflation is likely to taper off?
There are really two factors that are driving inflation now, and one way to look at them is, both have a temporary impact on the underlying inflation. One is clearly the unseasonal spike in agriculture prices that you referred to, which is clearly showing in fruits and vegetable prices, in fact, all the way since May of this year. The other one is the effect of currency depreciation, which is now filtering into inflation readings with a lag. So really, this is a near-term assessment. We hope that the impact of these two will subside over the next 3 to 4 months. Whereas there is a structural element to inflation as well, which has been in place for India for the last 4 or 5 years. And that's really a function of the overall supply bottlenecks and better rural demand in the face of constrained supply of protein food items. So we would think that inflation should revert to the earlier trend rate with a 3 to 4 month lag. The question really is whether RBI would be in a mood to see through these temporary factors or react to them.
Let's talk about the overall liquidity, liquidity tightness. Do you think that that is likely to continue now going forward?
Well, on its own, the liquidity tightness is not going to go away. We are in busy season. Over second half of the financial year, the banking system loses, roughly 80,000 to 1 lakh crore on account of rise in currency in the hands of public. So, barring any sort of intervention on liquidity from RBI, we would think that the liquidity deficit only continues to go up over the next 4 to 5 months. Having said that, we would think that RBI intervene on liquidity. We would think at some juncture they would want to revert to their earlier liquidity model of ensuring that banking system liquidity broadly hovers in the vicinity of 1% NDTL deficit, which is approximately 70 to 80,000 crores. What one also has to watch out for is if portfolio flows were to resume in the context of a lower current account deficit and India is in a position to post a balance of payment surplus this year, then that much of dollar that RBI buys will also infuse rupee liquidity into the system.
What did you make of the capital infusion announcements? Is it too little, and is it come at a good time or not quite?
I wouldn't, have a specific comment there. It is, given the broad requirements of lenders in the country and the asset quality issues that they are struggling with, clearly it's not enough. But one also recognizes the fact that given the state of the country's fiscal, possibly the government is not even in a position to offer much more at this time.
Okay, and Suyash, one word really on how do you expect the bond markets to perform in the near term? I mean, the last few days, whenever I've looked at bond yields, they've been very, very flat. I'm guessing they'll probably start a movement closer to the credit policy date, but how do you expect them to shape up?
Well, flat is good because if you really look at what's been happening over the last 3 months, we started with a fairly large amount of volatility in bonds, which was reflective of higher volatility in the currency market as well. And like you said, over the last few days, the volatility seems to have settled down, which is a good step one for investors into bonds. At step two, we would think that the current term premia versus the repo rate, which is in excess of 100 basis points, should start to compress once markets have a better handle on where the terminal repo rate is going to be in this cycle. So as of this juncture, you will find repo rate forecasts to be very differentiated amongst people. There are even forecasts tending towards 8.5 on the terminal repo rate, which is also reflected in term premium on bonds. if and when these settle down, we would expect bonds to start performing as well.
Suyash, great having you with us on the show. Thanks so much for taking the time out and joining in with your perspective.